Hello, everyone, and welcome to the latest edition of Conversations with a Pro Trader. I'm your host, Greta Wall, and with me today is Derrick Oldensmith. Derrick is the senior trader at T3 Trading Group and leader of T3 Live's Pro Desk virtual trading floor. Hi, Derrick. Thanks for coming back today.
Hey, Greta, it's great to be here again. It's great to be back. It's been a while.
It has been a while and lots to talk about. So first, let's get to your current trading. We're about halfway through the week. It is end of the day, Wednesday, so a little over halfway. How would you grade your week of trading so far? An A to an F, and why?
Um, I've been trading really well recently, really consistently for probably like a month plus now. It's been really consistent A-rated trading for me, I think on my side. This week thus far is no different. I was definitely wrong on a couple of things with today's trading session, but um when you ask me that question, I don't necessarily judge myself by whether I was right or wrong about the market. I judge
Mm-hmm.
myself by my process, if I followed my process, if I followed my edge and my game plan and my risk management rules and all that. And I have followed just about everything pretty perfectly to the letter of the law, which is how it needs to be if you're going to be successful in this business. So I'm happy about that. I felt I guess we're going back a couple months ago. It's funny how time moves.
Yeah.
But in like late September, early October, I felt like I was starting to make some trading mistakes. I went on a nice vacation, took
Mm-hmm.
a half step back, and then I feel like since I've been back from my trip, I've just been trading phenomenally well, and that's I guess highlights the importance sometimes of taking a step back, because it's easy to get a little bit burnt in this business, especially when you've been doing it for 13 plus years like I have at this point.
Yeah, kind of taking the brain out and giving yourself a rest, and then coming back with like a clear mind. And definitely some changes to the market when you came back. You took that vacation before the big rally that we saw in November. When you came back, how different do you think the market was from when you left?
Well, it was fortunate timing because the market was going through kind of a sell-off slash
Mm-hmm.
setup process in October when I was gone. And then at the end of October, it seemed to me that the stars were aligning to the long side of the market. So I think I did an afternoon meeting with my team on either the last or the second to last day in October. And I basically told everyone, like, hey, I know the technicals don't look great. I know we're trending down, but I'm just letting everyone know that I'm probably the longest I've been in like 2 years, like right now in this moment, because I think that we're going to start rallying pretty hard in November. And that's my thought process. And I want to put my money where my mouth is. So I was really loaded up at the end of October, and it worked out well. So I missed a little bit of the junkie price action in mid-October, came back
Mm-hmm.
in the end of October, loaded up to the long side, and November was just an absolutely fantastic month for me.
Yeah. Uh, you say the technicals maybe weren't really supporting your thesis at that point, but what was it that you were seeing in the market that made you shift so hard to the long side and see that coming?
Sure. So it was really the data that I was reading on the flow of funds and how that was set to shift into the month of
Mm,
November. So there was
okay.
kind of a confluence of factors there. First of all, at the end of October, the S&P had gone into corrective price action, which
Mm-hmm.
means that we're down over 10% from highs. And the Russell, which I also pay close attention to, was down like, I forget the exact number. It was nearly a bear market in the Russell. We were down like 18, 19% or so. Technically 20% is a bear market. So what ends up happening a lot of times, and I was just talking to my team about this yesterday, when the market goes into corrective territory, when you're down 10 plus percent like that,
Mm-hmm.
a lot of people start getting really bearish.
Yeah.
I think it's just human nature, if you will, that we tend to want to get more bearish as we're seeing the market go down, and more bullish as the market is going up. And oftentimes that's actually the right approach. That's called trend following, and
Yeah.
the trend is your friend. So, as people are becoming more bullish, it's typically better to go with that. As people are becoming more bearish, it tends to, be better to just go with that flow. But where that begins to change is in more periods of extremes, extreme sentiment, extreme positioning. And by the end of October, when the market had corrected over 10%, sentiment was starting to get extremely bearish. And if you look back over time, sure, there are plenty of occasions where a market correction has led to a bear market,
Mm-hmm.
but more times than not, you'll see all-time highs after the market's down, just over 10%, then you will actually see a full-on bear market hit. So I was looking at sentiment, I was looking at the percentage in which we were down, and then finally, and in some ways most importantly, I was looking at what we call just the flow of funds data. So
Mm-hmm.
that is data that comes from a lot of different resources. It's usually compiled by a lot of the major banks. Goldman actually does a great job compiling some of this data that basically just shows buying or selling that has to come from a lot of different vehicles. So CTAs, systematic vol control funds, trend following funds, hedge fund positioning, market maker dealer positioning, buyback information, and all of that was actually setting up in the beginning of November to just be pretty much, in some ways, buying across the board. And if we could begin to go up in November as some of that buying hits, it would actually lead to even significantly more buying. So just as a really basic example, buybacks are a really important thing in the market. November is a seasonally strong month. I always take seasonality with a grain of salt because I'm a big believer that just because something happened in a past period of time does not necessarily mean it has to happen in the future. But there's a
Mm-hmm.
reason why November is so consistently strong. It's because
Yeah.
the month of November has the most amount of buybacks typically out of any month of a year. So what we ended up seeing is we saw like $5 billion a day of just equity buybacks coming into the market. That's a pretty significant amount of demand that's just coming from companies themselves. At the same time, by the end of October, data also from Goldman showed that hedge funds had shorted individual stocks for 14 weeks in a row, which I think was the most amount that they've ever seen over the course of their data set. So they're beginning to position, they're ripe to potentially get squeezed.
Mm-hmm.
And then other types of funds that are more systematic in nature, CTA's example, were also shown that they were going to have to start doing a tremendous amount of buying in November. So I'm just looking at all this information. I'm looking at, well, everyone's becoming super bearish. Everyone thinks that the market has to go down. At the same time, I know that there is about to be a tremendous amount of forced buying that comes in the market. This doesn't have anything to do with fundamentals. There
Mm-hmm.
are some really smart people out there who are making bearish fundamental cases, hard landing, soft landing, whatever. I think that's actually been, we're probably seeing less of that now that we've rallied so much. That goes back a little bit to what I was just saying about how sentiment tends to follow the market.
Yeah.
But we were seeing a lot of smart people there at the end of October, like Mike Wilson and a lot of the sell side analysts coming out with just really bearish fundamental views of the market. It doesn't mean that they're wrong. The timing on the market from a fundamental perspective, I always think is really hard. I was actually
Mm-hmm.
just watching or reading something within the past week that cited several studies that show that even in a period as long as 10 years, sometimes your fundamentals don't fully play out, right? They say, I think this might originally be a Warren Buffett or Charlie Munger quote,
Mm-hmm.
rest in peace to Charlie.
Mm-hmm.
But they say that in the short time frame, the market is a voting machine. In the long time frame, the market is like a weighing machine. So basically, what that
Mm-hmm.
means is in the very short time frame, the market goes up because of votes. What are votes? Votes is people like me buying or selling stock. Every time you buy 100 shares of stock, that's one vote. Every time you sell, it's one vote. That's what moves the market in the short term. What moves the market, without a doubt, on the long term is fundamentals, but
Mm-hmm.
we know that fundamentals don't play out intraday necessarily. They don't play out day by day. So I have always wondered over the course of my career, like, well, how long of a time frame do I really have to go out for the weighing machine to outpace the voting machine?
Mm-hmm.
And I always thought it was like maybe like a 3 to 5 year period, but again, just this week I saw a couple studies that said it might actually be as long as 10 years. So you can take all of the fundamental bear cases that are out there. They may still be right. Maybe they're wrong. Maybe they're right. Only time will be able to tell. But in the short run, even if they are correct on the market's expensive and it needs to go down because the fundamentals don't make sense, whatever. If there's going to be all of this buying that comes in the month of November, $5 billion from buybacks, another, $7 billion a day from CTAs. And then as the market's going higher, hedge fund shorts are getting squeezed out. As the market moves higher, volatility, systematic funds are going to need to buy. That is just facts, right? That's just buying that's going to be coming in every day and creating an underlying bid to the market. So it was kind of just seeing all that data, seeing the sentiment, seeing where we were, that I thought we could rip higher in November. I didn't necessarily think it was going to be as big as it was. I mean, November was a
I don't think anyone.
massive, yeah, it
Yeah.
was a massive month. But I definitely was starting to turn bullish at that point, and it's worked out really well. It's just been a matter of properly managing profits and reward maximization based on game plans for trades that I have open. And then at a certain point, the move was so big that I was actually beginning to try to hedge myself to the short side by basically shorting the market, shorting the SPY, shorting the Qs on top of the longs that I have, which was a difficult trade for sure. But patience played out.
I think, what you've been talking about really speaks to your ability to know, to look past just technicals and fundamentals and charts and really know how the market works and the different things you're talking about, the data that you're looking at, the flow of trading versus just looking at a chart. Some traders, I think, get so stuck in only looking at charts and technicals and fundamentals, and yes, those things matter, but I think it really speaks to your ability to understand just how the market works and how that could definitely influence, obviously, the trend that we're seeing on Wall Street.
Thanks. I had a real eye-opening mental thought process actually just this week on Monday when it comes to tech analysis. I traded Monday from my dad's house on Long Island, and then I needed to get back to the city, so taking the Long Island Railroad back. And as I was sitting there thinking about the market, because why not? That's what we do. We just sit around and think about the market when we're not doing anything else. And I was thinking about the month of November, and I was thinking about all the flow data and everything, and I was just kind of talking to you, and I was thinking about what technical analysis actually is. Technical analysis is the study of supply and demand as represented by charts. In other words, technical analysis is the study through charts of how funds flow into and out of the market. That's literally what you're doing. So when you can look at data that's getting compiled that shows how certain systematic funds are going to be working, and again, that's how a lot of the market actually works in this day and age, is through algorithmic hedge funds and algorithmic execution robots. Basically, that is the same thing as technical analysis. It's the exact same thing. I'm just reading data off of a piece of paper that shows numbers instead of reading the charts. But it's both understanding supply and demand. It's both understanding flow of funds. That's the essence of what we're doing. So who cares where it really comes from? Who cares if it's me reading a bull flag in a chart that's representing demand, or me reading that, oh, guess what? Equity buybacks for the month of November are set to be $5 billion a day. What does that actually mean for the market? It's the same data, just in a different form.
Yeah, really good point. Okay, let's get to the news of this week. We're focused on the labor market all throughout this week, starting really yesterday. We got JOLTS on Tuesday, ADP's private employment report this morning. Both of those came in lighter than expected. Slowing job growth is good news for everyone hoping the Fed is done hiking rates. What does this data mean for you when you're looking at the market?
So one of the really cool things about the trading business, and we've seen this recently, is it's always kind of changing. So I have really seen periods of time in my career where certain economic events really, really matter, and then all of a sudden they don't matter anymore. Yep. And certain numbers that have never mattered ever all of a sudden really matter anymore, really matter. And the JOLTS number, I don't really remember ever at any point in my career of doing this, the JOLTS number really, really mattering, really, really moving markets.
Yeah.
And then all of a sudden, 2 of the last 3 months, or maybe 3 out of the last 4 months, if you want to include yesterday, we had two JOLTS numbers that moved the market like massively. One was to the upside, and one was to the downside. I don't remember the exact dates or the exact numbers. One was a meet, one a beat, one was a miss. And the market for those couple of months was viewing good news as bad news and bad news as good news, right? So
Right.
so what does that mean? So when you're looking at JOLTS, what is the JOLTS? JOLTS is a job opening number. So in theory, more job openings is a good thing, right? The economy is humming along, and companies want to hire. And if you have less, that's supposed to be a bad thing. But the market just a few months ago, when we missed really badly, meaning that there were much less openings than expectations, the market like went on an absolute tear. It was a huge upside move. And then I think it was the very next month, maybe I have this backwards, it's a little bit fuzzy in my head, but then I think it was the very next month that the opposite happened, that the number came in hot. There were way more job openings than expectations, and the market got absolutely crushed on it. And why is good news bad news and bad news good news? Because of the Fed.
Yeah.
If we're getting bad news economically, and it's especially true when it comes to jobs numbers, then the Fed is going to stop hiking rates and maybe even potentially lower at some point, and the stock market in theory should love that and can potentially go higher. So we had a period of time there where bad news was good and good news was bad, but I think that period of time is over. I've been starting to say that for maybe a month now, and I think actually the one exception up until possibly now, and even this might be changing, has been labor market numbers. I think that labor market numbers are the one exception, especially like a JOLTS number, where bad news could still be good, because some people are still a little bit nervous that maybe the Fed can go back into hiking or higher for longer, or whatever it is that they want to do. But that will signal that they're done. They've all but said that they're done hiking. So now,
Yeah.
if you can get rid of the fear that the Fed is actually going to hike, the economy starts really mattering again. So you're going to have bad news be good news if the Fed's not going to continue to hike. I hope that I'm saying that in such a way that everybody is able to understand. Like, if your fear was that job openings being too high means that the Fed is going to hike, well, now the Fed said they are not going to hike. So job openings being a little bit better than expectations can actually become good for the economy again, which is therefore going to be good for the market because they're not going to be raising rates anyway. I think
Yeah.
maybe I just said
And
that a
that's
little bit
that
more
soft
clearly.
landing that the Fed's looking for. They've said they're
Right.
looking for. Yeah.
Soft landing, if there is a landing to even be had. So what we saw yesterday was a jobs number the JOLTS number come in light. So
Really
bad
light.
news should be good news. Yeah, bad news should be good news. And we had an immediate uptick in the market, but it didn't lead to any follow through at all. Nothing like a couple months ago when we had a miss on JOLTS that sent the market like up 2.5% or whatever it was on that date. This was, a quick uptick. We tried to follow through for a half hour, and then by midday, the market rolled back down, went sideways, and decided, you know what, we don't really care. We're not going to sell off on this bad number, but we're not going to buy this market up either. And then today we tried to gap up, and they sold us all the way down also. So I think that we're finally seeing a little bit of a regime shift here, where good news can be good news again, and bad news can be bad news for the economy, as long as it's not extreme. If it's like
Yeah.
an extreme massive beat, for example, this coming Friday on the unemployment number, if way more people are working than expected, then okay, maybe there's a possibility that like hikes could go on the table. But I think at this point, like numbers coming in line might be the best possible thing that could happen to the market, where okay, the economy's not falling apart, but it's not so much of a problem either that the Fed needs to consider keeping rates really high or even hiking again.
So the jobs report is coming up on Friday. I think the expectation is like 190,000 jobs for November, which is still a slowdown, but still, obviously some hiring happening. What's your strategy heading into binary events like a jobs report that you get before the market open on a Friday?
So the first thing I want to think about is how much will this actually move the market? Do I think that
Mm-hmm.
this can actually lead to a really significant move or not?
Mm-hmm.
And the answer to that question really decides what if I'm gonna adjust my approach or adjust my game plans. So first of all, if anyone's listening who doesn't know me very well, I combine day and swing trading. So I always have positions on overnight. I will have positions, 17 positions right now. I promise I'm going to have positions going into the number on Friday. So what I have done in the past for certain major economic numbers, like in 2022, when the CPI was the big rage and was moving the market really, really big, I was
Mm-hmm.
trying to find out what the options market was pricing in as far as a movement. And then basically, especially for my swing positions that I'm already in, clustering bids and clustering offers somewhere in front of that expected move so that I can basically earn a premium on the risk that I'm taking for my trades.
Mm-hmm.
That's what I do if I'm expecting a really, really big move. The moves off of economic numbers and even the Fed meetings at this point have started to become so muted that that advantage doesn't really exist for me in the same way.
Mm-hmm.
So the truth of the matter is for this number on Friday, I am probably not doing anything specific. I am gonna I already have game plans in place for all 17 positions that I'm in, and I will just follow the game plans as I've built them out and kind of trade around it. Now, I do have kind of general news rules that I preach.
Mm-hmm.
So what I'm going to want to do, I'm assuming that the number comes out at 8:30.
Yeah.
What I'll want to do at 8:30 a.m. Eastern on Friday is I will basically mark the price that the SPYs, Qs, and IWM are trading at. So I want to know the exact price to the penny that the SPYs are trading at. And then I see the initial reaction to the number, up or down. But I do it in relation to that starting point. That starting point's really key for negation. So then broadly, if this is my starting point and we're trading up, the general rule, and there's other factors that come into play, is I would rather be long than short.
Right.
I want to go with the movement of that market. If there's a bull flag that comes in or a wedge or a setup, I want to be looking for continuation off of that. It's also true. If we are below the starting point, the market's interpreting this number as bad. So
Mm-hmm.
I don't have to I'm not the one that's coming in and is trying to decide, oh, is this a good number or is this a bad number? I'm letting the market do it for me. So now if
Mm-hmm.
we're trading below that starting point, I generally want to be short, not long on any new positions that I'm looking to open. So if a bear flag comes in or a bear wedge comes in or whatever, I will look to potentially short those positions. Now, the final thing that I'm paying attention to is if an initial move gets negated. So again, if the starting price is here that I'm looking at and we have a quick uptick and then 3 minutes later the market is rolling all the way back down and breaks the low of that starting point, that's
Mm-hmm.
actually really, really important. I know some traders even like to do like an immediate scalp in the other direction. In like if the immediate move is long, they know the starting price and they'll like try to scalp to the short side on the market for like a quick trade. Because what you're doing there is when the market negates the initial move, every single person that, let's say, bought in those first 3 minutes are out of the money. You know that if we got below the starting price and after rallying for 3 minutes, and this especially applies with like Fed meetings where you get a lot of that whipsaw
Yeah.
action,
Mm-hmm.
every single person that just bought is out of the money. Well, what do people do that are out of the money? They either hope and pray that their position turns around, which is a great way to not be a successful trader, or they manage their risk by stopping themselves out. And
Mm-hmm.
stopping yourself out of a long position is called selling. What does selling do? It drives the market down. So if that starting point breaks, you can sometimes get a really fast move in the other direction, and that's something that I pay attention to as well. So that's broadly how I approach any major number.
Okay. As you mentioned, this labor market data, the JOLTS, the private jobs number today, Friday's jobs report number, is all really just important for the Fed meeting next week. We have the rate decision next Wednesday. Yeah, next Wednesday, the 13th. So the market, of course, is assuming the Fed is done hiking rates, even now starting to pencil in cuts as like early as spring of 2024. What kind of language should traders be hoping for from the central bank, especially the chairman in his press conference next week?
Sure. So it's a little early, but I actually think this Fed event is going to be mainly just a non-event.
Hmm.
I don't think that anything major is going to be coming from this at this point, unless
Yeah.
all of a sudden, for some reason, he signals that hiking is back on the table, which, based on the recent language from Powell and from the other Fed members, it does not seem like that's going to be happening. So, um, like usual, the Fed has really shown their hand. They're not gonna, there's gonna be no change here. They're not gonna hike or cut. So what could potentially move the market is the language around them doing nothing.
Mm.
And I think that language is already priced into the market based on the things that Jerome Powell and the other Fed members, Waller in particular, have said just over the course of the last few weeks here, where they're
Yeah.
basically, it's just going to be a repeat of the information that's already come. I'm not expecting anything new. There's always a wild card with the press conference, with the Q&A,
Hmm.
because sometimes, there's a slip of the tongue. But at this point, Jerome Powell's been doing this for a long time.
Yeah.
He's not a rookie at this. I don't foresee him making any real slips of the tongue. So I actually think that this Fed event is going to be largely a non-event. We'll get a lot of anticipation, and we'll get volatility at 2 o'clock, and then more volatility at 2:30. But I don't see anything changing here. I don't see anything that's going to come of this. It's necessarily going to be super market moving, and it was the same way on the last Fed meeting also.
Yeah. We last heard from Chairman Powell, I think it was 2 weeks ago, because now they're in their like blackout. Well, maybe it was last week. They're in their blackout period before the meeting. Now they're like not allowed to speak. But when we last heard from him, he said basically they're not even thinking about rate cuts at all. They're like not even on their agenda. But then a bunch of analysts have come out saying they're expecting as many as 4 rate cuts in 2024. Some still say, only 2 starting this summer. Where do you fall on where you think cuts might happen in, when you're looking at the economy, the
Sure.
market, the strength of the market, especially being uh, something that the Fed does have to consider.
So I've always been in of the case of, that the Fed, I think over the course of the last 2 years, have perfectly predicted every single Fed meeting before the Fed meeting has happened on what they were going to do. But it's by no means because I'm a genius or anything special. All my prediction has always been that the Fed is going to do exactly what they said they're going to, and it's
Yep.
it's really been that simple. Literally every time when the Fed was like, "We are going to hike by this amount in the next Fed meeting," guess what? They hiked by that amount at the next Fed meeting. You
Yeah.
really did not have to be a genius to predict that. So this is actually interesting, though, because we're not talking about what the Fed is going to be doing at the next, at the meeting in a week from now, or at the meeting in January. We're talking about what the Fed is going to be doing in May. And I
Mm-hmm.
think that any Fed member would always say, hey, it's hard to say exactly what we're going to do that far out, and we're going to be data dependent, and all of their fluffy language that they like to use. So normally I would still go with that same thought process. Well, what has the Fed said? The Fed has said higher for longer. So
Mm-hmm.
the Fed has signaled to everyone that they're just going to keep interest rates the exact same until one of two things happens. Either inflation's at 2%, not 3%. 3% means that we still have work to do. Either inflation's at 2%, or the economy is going into like a bad recession where we have no choice but to actually cut to kind of protect things here a little bit. So that has been my thought process, but I think there's actually cover here for the Fed to cut if they want to. I still think it'll be a little bit later, probably, than the market's pricing in, maybe more mid 2024. We'll see how that plays out. But there is, I think, room for the Fed to do what people are referring to as maintenance cuts, because what's happening right now is it's not just the nominal absolute interest rate. It's the real rate. And as inflation is going down and interest rates are staying the same, the real rate's actually been continuing to move higher. So even though the Fed has not continued to further increase the rate has gone up.
Yep.
And that's on a real basis. And that's just because inflation has moved lower. So you have room for the Fed to actually stay higher for longer, and actually stay pretty much at the same level on real terms, as they actually give you 1 to 4 25 basis point cuts. if that makes sense. And now it seems like the market is sniffing that out a little bit, and you can just see that in the move of like the TLT ETF over the course of the month of November, where they're not only pricing in, I think, to the market at this point, and that's the data that you're referencing. They're not only pricing in that the Fed is done hiking, but they're pricing in, I wouldn't call them stimulatory, if that's even a word, cuts. They're not cutting to stimulate the market because of a recession. That's not what's being priced in. What's being priced in, and why the TLT has moved higher, is these maintenance cuts, which actually just really kind of keep it at the same level on real terms.
Yeah, definitely makes sense. Got lost in my questions here. Okay, so you mentioned this already, but November was the strongest month for the S&P 500 since July of 2022. Obviously, a huge rally happened in November, more than I think anyone was expecting. So far in December, we're 6 days into the month. That rally has taken a breather. Do you think we got overextended last month?
Oh, we certainly got extended. We got overextended for sure. I mean, it was a huge move, and all of the metrics that I look at to measure extension were showing a market that was at extreme extension. But we have now gone sideways for like 2 to 3 weeks, depending on which index that you're looking at, SPYs or Qs. So markets get extended. The way markets work is markets work in periods of expansion and consolidation over time. And in expansionary periods, markets move from being more overbought, let's just say it's an expansionary period to the upside, more overbought, more extended to the upside, and then they go through a series of corrections. This is actually what an uptrend is. An uptrend is a series of, or a downtrend, but let's stick with uptrend to keep it simple. An uptrend is a series of moves higher, expansionary moves higher, that get the market extended, that are then followed by corrective action. Correction happens in one of two ways. It happens through time, meaning that the market moves sideways. It's known as a bull flag, or it happens through price, which means that the market goes back to some sort of technical equilibrium, has a percentage retracement of the original move, creates a higher low as buyers come in at higher prices and sellers get exhausted, and then that brings you up for the next leg of the rally. So what we've seen now for like 2 or 3 weeks actually is time correction, which tends to be very bullish. So the market has been digesting the massive gains in November by moving sideways. I mean, the SPY, the S&P right now is at the same price that it was at on November 22nd. So that's like a couple of weeks. And for the Qs, it's even more than that. The Qs are at the same price that they were at on November 14th. So most of this massive November rally really happened within the first 2 weeks, which again just shows you how insanely powerful that was. So you had huge extension on the daily chart. A lot of that's actually been satisfied. You had pretty big extension on the weekly chart. That's also working its way off through time and is slowly being extended, is slowly being corrected, I should say, through time. So if we can get through that and we can continue to hold up, it can set us up for another leg higher into the end of the year, which at this point is what I've been calling for that, and I've been looking for it for the last 2 weeks. But I have been actually right now as we do this, I'm 100% long again. But up until 2 days ago, I had actually been net short the market for like a week or so, because we just got so extended to the upside that I was looking for this time or price correction to come in. And it's been entirely through time. Finally liquidated the short positions just a couple of days ago for a profit. And I'm like, okay, we're finally hitting the point here where maybe we can begin to get continuation. I thought there was a chance that could start today. We're still in like a historically long gamma environment, which insulates moves. So what it means is basically as the market's moving higher, there's a lot of selling that's coming in. As the market's moving lower, there's a lot of buying that's coming in. The note from Goldman that I think I read yesterday said that it's the longest gamma that they have on record, and it turns into $10 billion per 1% move in the market, which is a huge number. And that's been what's been helping to insulate us kind of move sideways. That's going to work itself off over time and eventually probably especially after options expiration this month, will loosen this market up where we can begin to work our way higher or potentially break down if that's what the market wants to do also. But that there's just been this insulating factor in this market where we can't go. And today I thought maybe today could be the day because we had a really tight inside day yesterday. The market was gapping up nicely this morning, and I described myself in the morning meeting today as cautiously optimistic that we could continue, but with still a very high probability that we stay stuck in our range. And of course, for the third time, I feel like in 3 weeks, we basically had like another mini false breakout of the range in the market, and we sold all the way back down. Today was actually a pretty ruthless sell day, and I think on a very small time frame actually puts bears back into control. So after today, I would say on a very small time frame, you can't ignore today's candle. You have to say that bears are a little bit in control, but really for the month of December, I'm leaning bullish through the end of the year and probably through the first half of January, because you get that strong January effect that usually comes in the first couple of weeks there also.
Okay. I know you could probably hear my dogs. I muted my microphone for the audience, so they didn't have to listen. They could only hear you. We got a good question that I think goes with what you're talking about right now. Vincent asked your thoughts on the recent relative strength of the Dow. Says, I know there's been a lot of talk about rotation into the small caps, but do you think the Dow stocks might be being overlooked?
So the move in the Dow has been massive. I'll be 100% honest. I don't spend a lot of time looking at the Dow, and the reason for that is because it's just 30 stocks. So I don't look at the Dow very often because I don't feel like it gives me a good feel or technical view to what the market is actually doing. You had, I think, just last week, a big up move in 2 of the 30 stocks. One was Salesforce. Salesforce reported a massive earnings report, and it was up huge. And I think on the same day, United Healthcare had like a really big upside move, which I think is also in the Dow. So, you get 2 out of 30 stocks that happen to have positive news events and give a really big up move on that news event, then you're going to be moving the Dow in a really big way. So yeah, in some ways the Dow has actually been the strongest index over the last month or so, but I take it with a grain of salt, because unless you're very specifically focused on those 30 stocks, it doesn't matter nearly as much as the bigger picture of the S&P, the NASDAQ, the Russell, or even looking at like an equal weighted S&P is something that I would prefer to look at to a Dow to have just kind of a better understanding what the market has been doing. So maybe this move has been overlooked a little bit. It's been super strong, but I also kind of think it's overlooked for a reason, because 30 stocks really is never going to give you the real picture of what the market's doing. And if you just so happen to have a couple of those 30 names, like what happened last week, have positive news events, then it can really skew that index either to the upside or the downside.
Yeah, really good point there. Everyone who's with us live, just a reminder to submit any questions you have with Derrick. We're over halfway done here, so I just want to make sure we get to those before we wrap up. So Derrick, let's look back on this week. Tell me about the best trade you've had and what made it go well. If you have a chart you can share, that'd be great, just to show how the trade developed, what you saw, why you got in, etc.
Sure. Let me share a screen here while I try to come up with an answer. So here's one of my screens. I happen to have the DIA up on it right now because of the question that was just asked. So what you have to keep in mind is even though I do some pure day trading, like I did, a purely day traded Upstart today, a purely day traded Beyond Meat. There were positions that I was into and out of, and they were both good trades. And by the way, neither of those trades came from me. Those were ideas from other people on my team that were communicated in the morning meeting. I think I want to give credit to the right person if I can, that they came from Nick in my VTF. So if it was you, Nick, if I got that right, big shout out for the money that you made me in those stocks. Awesome stuff. I love that type of communication. When you guys make me money is the best. But I'll never really consider that to be like a best trade. Like, Upstart today was just a momentum trade off the open of the inside day and up with this. I really don't like this company. but it's got a 45% short float. It squeezed really hard for 2 days. It gave a rest day yesterday. And this is just a momentum day trade strategy of the inside and up off this rest day. I think Sammy from T3 Live will calls this like a 1-2-3 play sometimes. But I think technically he wants the initial move to be one bar. But for me, I call it an inside and up in a name that's got a 45% short float. So I mean, this was a great trade off the open. I actually mismanaged the execution by accident, which was in my favor. The proper entry I think would have been $34.12. The break of yesterday's high. I bought $34.02 with some size again on a pure momentum trade, and I liquidated the position again just as a day trade. I was out. I didn't catch the full move. I was out by like 36 quarter or so, and it was great. Put some money in my pocket. Beyond Meat was similar but different setup on a highly shorted name. I was looking to see if growth could be strong today. It generally did not disappoint. I bought Beyond Meat pretty much off the open. Ended up using the opening low as a stop loss. It closed well. Like those are fine little day trades. Same pattern here, by the way. Highly shorted stock, pure momentum name, inside and up pattern on the daily chart, looking for continuation of the short squeeze. But those are great to be able to put money in your pocket. But I actually find that the bigger positioning that I do that can be multi-day, multi-week, even multi-month trades, a lot of what I do is having a portfolio, having these positions on, and then kind of actively day trading around the core portfolio for day-to-day cash flow. And interestingly enough, I had a fantastic, November, just to give myself a pat on the back again. It was super profitable, and it was super profitable to the long side of the market because I was, again, I gave this afternoon meeting to my team either on October 30th or 31st, where I said, I'm the longest I've been in 2 years, and this is the reason why. And then we caught this move. But I actually think that the best trading that I've done, and it was a multi-week trade that concluded 2 days ago, was to the short side of the market. So I have rules in place. One of the ways in which I measure extension in the market is by where the market is trading versus space between 21 EMA. So the 8 EMA is my blue line. The red EMA here is my, the 8 EMA is the blue line, and the red EMA is my 21. The space between the 8 and 21 EMA is the space that I consider to be technical equilibrium for any chart or any time frame that I'm looking at. And in an uptrending market, I consider the 8 EMA to be the upper band of equilibrium because it's always going to be higher than the 21. And in a downtrending market, I consider the 8 EMA to be that lower band of equilibrium. So into these more extreme up moves, I'm just measuring the distance between where the market is trading and where the 8 EMA is. And what I've seen very consistently at these prices over the course of the last 2 years now is whenever the market, the SPYs or the Qs, specifically those ETFs, get $10 or more away from the 8 EMA, we are in a territory that I consider to be extremely extended. So, if the move is to the upside and we're extremely extended to the upside, I don't want to be putting on any new longs when we're more than $10 extended away from the 8 EMA and the SPYs to the upside. And in fact, it's only in that area that I want to begin to look for counter trend shorts or hedging shorts or whatever it is. So I have a trade that's been very consistent for me for the last 2 years, where every single time the market is, more than $10 away from the 8 EMA on the upside, either the SPYs or the Qs, I begin to build into SPY and Q shorts. I do that as a trade with a specific rule set, but that trade also has the benefit of hedging me because I'm usually in a bunch of single stock longs at the same time. So at a certain point of extension, I actually begin to build out of my long positions by selling for profit and build into short positions. And if the extension can become extreme enough, I can actually get net short, which is what was happening by, I have a false print here in the SPYs, which is throwing off my chart, which was actually happening by the end of November. So I first shorted the SPYs via UPRO on November 3rd, and I liquidated the position actually the morning of the 10th after this down move because we had fully corrected ourselves to the ADMA. But you could see on the 11th, we got extremely extended. I shorted the SPYs via UPRO, and I shorted the Qs via T-triple-Q that day. And I got fully out of the SPY position on this day. I did not get fully out of the QQQ position. So I actually was short the Qs via T-triple-Q from November 3rd through 2 days ago, through December 4th. So I started shorting the T-triple-Q at, somewhere around $36, and I liquidated the position somewhere around $42, and I made money in it. And that's the best trade that I could come up with that is still within this week. And the reason how I was able to make money in it is because I had a very specific rule set and I had a very specific game plan, and I stuck with it and I followed it. And that game plan was based off of an understanding of extension, where on the way up at certain points here, I was sizing down for a loss. And then as we became more extremely extended, I was rebuilding in, but never getting fully flat. And then on any intraday movements to the downside, I'd be booking some profit as it comes down, reshorting as it bounces back, booking profit as it comes down, over and over and over again, until the market actually began to satisfy its extension. So to me, this is the best possible trade I could have been in. And I made like barely anything on these trades compared to what I made on the long side over the course of the month of November. But in some ways, I think that this was the best trading I actually did, because I had a very specific game plan that I was able to follow, where the market was able to continue to move against me and against me and against me over time. But through proper risk management, trade management, position sizing, finally, when the market was no longer extended, I was able to not only make a little bit of money, but I just in case something actually bad happened, or not even bad, but if there was a bigger price correction that could occur, that easily could have occurred, but did not occur over the course of November. If, let's just say here, we got really extended again at highs on November 15th. If we pulled back from that high of, and again, the triple Q ETF that I have open, we could look at the QQQ, it's the same thing, 43.78. We could have pulled back all the way to 39.50 and been healthy. And that would be a, $4 down move in the Q. And by healthy, I mean the market would still be bullish. We could have just pulled back to $39.50 or $40, created a higher low there, and then worked our way back up. Instead of a price correction, that's what I'm describing, we did a time correction. We went sideways. That goes back to what we were talking about earlier. So I had these trades on that had me fully hedged and set up to be able to make pretty good money should the actual price correction come in. It didn't, yet still managed to not only not get hurt in an up move, but actually come away on it in a profitable way. So, by far not my best P&L trade over the course of the month, but if you want what I think I actually executed best and did best, it would be the way that I was able to short the SPYs and the Qs for most of the month of November, even as I was long a lot of individual stocks, and still come away profitable from it.
Really good there. And then, okay, I'm going to make you talk about a bad trade. So what would you say has been your worst trade over the past week? And you can do the same kind of thing if you want. You don't have to, but kind of show the setup into it, why you took it, and then how it developed.
So it kind of circles back to the question that you were asking me, the first question you asked me about how I would grade my trades. I have trades that failed. I had a pretty bad trade in ARM today. It's my worst name on the day. The idea itself totally failed, but I don't necessarily think that I traded it bad. I wouldn't necessarily consider it to be a bad trade, but I'll reshare my screen here and we can take a look at it. Anyway, again, I wouldn't consider it to be a bad trade, but it was a failed trade. It was a failed idea, and that's fine. That happens. So as you can see here, ARM, it's a somewhat new issuance, was building out this, really nice bull flag, bull consolidation pattern here. The entire market was set to gap up this morning. We knew AMD was going to be having an event at 1 o'clock today. And I actually felt, I felt that there was a real chance that this market actually could break out and move higher today, despite the fact that we're still in this super long gamma environment, which would actually be a piece of evidence that's contrary to my thought process of continuation. But I thought if the market could go, this arm was pretty much set for a breakaway gap higher today. A breakaway gap is when the market gaps above a resistance level. So that resistance of arm is like 64.40, 64.50. So I actually bought arm for continuation trade. Pretty much the exact same thing I just showed with Upstart, the exact same thing I showed with Beyond Meat. Similar but different here. Just buying a bull flag breakout. At the open today, I bought, I think, 64.49 or 64.50 was the market buy price I got in ARM. And the trade just totally failed. It totally, completely, totally failed. And you can see it pretty much right away. It's one thing for a stock that's gapping up to pull back a little bit off the open because it's extended via the gap. That's not what this is. This is just a straight failure. They gap this thing up, it trades straight down. It not only fills the gap, it goes beyond that and is showing just total failure. And it's relatively weak to the market. Yeah, the market pulled back off the open as well. The SPYs pulled down, the Qs pulled down pretty brutally. But even the SPYs and the Qs, as much as they were selling in the first 10 minutes of the day, they didn't go red in the first 10 minutes of the day. This arm was a failed breakout. And from a failed move comes a fast move. I know this. So you have to make sure that you are managing your risk properly. So, trades fail all the time. It's part of the business. What matters is how you manage your risk within those trades. So the more momentum-based stock, if I'm trying to be heavier in this, I got to stop myself out on it. I actually have, part of my position that from a bigger picture, I'm planning on giving down to the bull flag low. That trade's certainly not looking good. So I'm set up to potentially losing a little bit more money in this tomorrow because I kept a little bit overnight. But we'll see because the market's not looking great after today's close, and nor is this failed breakout in this name. But yeah, that's an example of a failed trade. But to the person who I see in my VTF out of the corner of my eye who's trying to blame himself for the idea, it is not your fault at all for losing me money. It is my own fault because I'm the one who took the trade. And further to say that it's not my fault either at all. I wouldn't change anything I did with this. I will lose the money that I lost in my ARM trade today 100 out of 100 times, and I will not do anything like that because I believe that if I do this exact same trade with this exact same setup over and over and over and over again 1,000 times, that I'm going to come away profitable from it. And I work in a game of probabilities, and in this case, this trade just didn't work out, and it is what it is.
Really great. Yeah, I mean, management is really what it comes down to. Even if you lose money, if you follow your rules, that's what you're supposed to be doing. Okay,
it's the key to the business.
Yeah, let's reflect back on 2023. We have like 25 days left of the year. What did this year teach you about trading, and how have you, adjusted your strategies throughout the year and as the market? I'd argue we've had very different markets multiple times throughout this year, very different environments throughout the year.
I thought this was a fantastic trading year. I know that there's a lot of people that have struggled this calendar year who don't think that it was a good year, but for me, for the way that I trade, for my approach, this was an awesome year. I'm just looking at the big picture chart of the S&P as I kind of talk to you here. I think that the market went through some major changes this year. And I think, so I know a lot of really good traders who have been struggling this year, guys and gals who have been doing this for, a long time, like me, like 10 plus years, and they've really been struggling this year. And so what I've always seen over the course of my trading career for successful traders struggle when the market environment changes, and they struggle to adapt to the new normal of that market environment. The number one reason why beginner traders fail is because of a failure to manage risk and manage money consistently over time. I think the number one reason why successful traders fail is because the market environment changes in such a way that they struggle to adapt to, whether it's because they struggle to figure out what has changed, or because they're just stuck in their ways because they've been doing something for so long that's worked for them. And then, to some degree, it's a risk management situation also, because traders who have been doing this for a long time, who have been really successful, they might be used to trading really big numbers, really big P&L numbers, because they've been doing it for so long. And they need to know when the market's not working for them and not working for their strategies, or when they're struggling to adopt to the new market, to size down. And I could speak for myself, that's a very hard thing to be able to do, because when you're used to working with numbers at a certain size, and then you take a zero off the end of that, all of a sudden it feels like it's like play money. It's not real, and it can be difficult for you to really care and really focus on it. But the key to success in the business is always about consistency. And whether you're doing it with $100 or $1,000, it's about having the consistent profitability and then adding scale onto it. So there have been a number of changes that I really think are what I call market dynamic related, that have changed the way the market trades. One of them, without a doubt, is zero DTEs coming online. You have zero DTEs. It's a leveraged product that expires in either that day, or it could be one DTE and expiring the next day. But all of a sudden you have a brand new leveraged product that becomes 40% of the options market. And as the entire options market itself has really increased, that's changed the intraday price action of the market. It's changed the way that it trades. We get so many more of these intraday bottoms and intraday reversals than I ever remember seeing. And I've spoken to a lot of really good traders who are used to, like they're momentum traders. They're looking for the momentum trade off the open. They're taking a lot of sides off the open. Then they get stopped out because the position goes against them. And then at 12:30 in the afternoon, next thing you know, the market's rolling up and their idea's working, and they're just sitting on a nice fat loss, pulling their hair out about how they're not making money on the trade, as just an example. And the adjustment that needs to be made for those people, I think, is sizing related more than anything. If that's your idea, if that's your trade, but it's not been working now, but you keep getting pushed out and then the trade works, start smaller, or be more patient on the entry. Start smaller and build in, so that instead of getting pushed out when that midday reversal is happening, you're actually hitting your maximum size as that midday reversal is happening, and then you're able to take advantage of the market moving higher. So that's one. And then the other really big thing I would say is, this has been an ongoing study for me for a couple of years, as I've started to learn the importance of this, and I'm still very much in a learning phase myself, is really learning to dissect and understand that flow of funds data that we were talking about earlier. That's been the key to this market. Just a big shout out to my team in the Pro Desk virtual trading floor. I'm working with some fantastic, awesome traders in there, some really knowledgeable people. But we came into the beginning of 2023, once again, when sentiment was pretty bad, pretty bullish, and quite a great opening move. And then in the April-May period, when the market was stuck going sideways, we're looking at the same data and sentiment and positioning and saying, everybody's really bearish right now, but this consolidation pattern is going to break to the upside. And it broke up in a huge way. And we were able to capture this entire trend in May, June, and July. And then at the end of July, the opposite came in. Sentiment was getting extremely bullish. Positioning was getting over positioned to the long side. You combine that with a technical push through failure on a really key day on July 27th. We turned bearish. And guess what? The market then went down for 3 months and gave a full correction until the very end of October. The very end of October, when the flow data changed again and sentiment then became super bearish again, that we said, okay, I think it's time to become bullish again. So that's been the biggest change and adjustment for me in my trading over the course of really the last couple of years. But I feel like I was particularly successful with it and implementing it during the during the year of 2023. And honestly, by doing that, again, just a big shout out to the team. And anyone that knows me well, knows that I am always owning my failures like no one else that's out there. And I
Mm.
love, reviewing my mistakes publicly with everyone so everybody can learn from it. But I also want to give credit to myself and to the team and to to Patrick Hoff, if he's listening, and everybody else in a big way. We were on the right side and perfectly called pretty much every major market movement the entire calendar year. And that's a phenomenally good job. And look, I also even know from experience trading, sometimes you even call the idea and you still don't trade it right and position yourself right. But
Mm.
for me, it was just a perfect combination of not just calling it, but positioning myself right, taking advantage of it, having game plans in place to maximize my reward. And guess what? I still got 25 trading sessions left to give my entire year back if I want to be a bonehead. It can happen. Crazier things have happened, but hopefully I'm set up to close out what has been a phenomenal year for me, and I think for a lot of the members of the team that I'm working with.
Yeah. All right. We are out of time here, Derek, but this was a great discussion. Thank you again for doing this with me all throughout 2023. This was a new project we launched for this year, and I think it's provided some really great content for traders. For everyone still with us, I've posted a link in the chat for our next event next week. Scott Redler will be back for Fed Day next Wednesday, another T3 Trading Group Pro, and then we'll get Pat and Josh also back on before the end of the year, kind of end of the year here with our pros. So thank you, Derek, for today, and I hope you have a great rest of your week.
Thanks, Greta. Appreciate all your work.